My suspicion is that what we do as a society is what we did in the decade of the 1970s. We debase the currency. We reduce the purchasing power of our obligations so that we honor our obligations in a nominal sense, but not in a real sense. The Office of Management and Budget suggests to us that in the decade 1970 to 1971, the purchasing power of the US dollar was reduced by 75%, which means that $1,000 of savings in 1980 bought $250 worth of goods in 1971 prices. It is not coincidental, I think, Anthony, that during the period when the purchasing power of the US dollar declined by 75%, that the gold price increased 30-fold. I'm not suggesting that the gold price will go up 30-fold from here, but I am suggesting that in the next 10 years, the purchasing power of the US dollar in terms of devaluing our debts will go down by 75%. And I suspect that assets that have traditionally done well during periods of time when the purchasing power was under fire will do well. And I suggest that gold is one of those assets.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Rick Rule. So Rick is the former president and CEO of Sprott US Holdings with decades of experience in the commodities business. So Rick, thanks so much for coming back on the podcast.
Pleasure to be back with you. Thank you.
No problem at all. I've always loved speaking to you, and it's we're definitely in a very interesting time at the moment with everything that's happening on the world. We look at Liberation Day, tariffs and increasing tariffs on China, and then the removal of tariffs on everywhere else. And I'm sure by the time this interview is uploaded, there'll be something different entirely. But I'd be interested to hear, what are we seeing? And do you buy into sort of Trump's narrative of why he's doing it? Or do you think there's something behind it?
I'm not sure why he's doing it. I can tell you this, that tariffs are at their root taxes, and I believe that taxes are bad, so I'm anti-tariff. I realize that other nations employ tariffs. I read a post on social media that say 170 governments worldwide impose tariffs. How can tariffs be a bad thing? Well, 170 countries worldwide are wrong. Governments love tax, and taxes are pernicious. Taxes are evil. If we actually wanted to become more competitive as a country, my suspicion is what we should do is we should alter our tax code to make our tax code more investment friendly, and less consumption friendly. As an example, Trump's chief concern seems to be with China right now. If I went to build a factory in China right now as a foreign investor, and that construction technique was tilt-up concrete, the predominant form of construction for a factory, I could expense my production costs against current income and take those tax loss carryforwards forward as far as I needed them to. In the United States, I would amortize that construction expense over 30 years, which is to say I could reduce my income by about 3.3% a year for 30 years, as opposed to expensing them in China. If we really want to make the US more competitive, it would be reasonably easy to do. All you need to do is make the tax code and the regulatory framework more investment friendly than consumption friendly. That would appear to be a task that's too hard for American voters. They would prefer to address their shortcomings by attacking others.
Yeah, it's an interesting perspective, but I guess there is also the issue, and me being the devil's advocate, where China has these government sort of sponsored or backed banks, which are plowing billions of dollars into these manufacturing investments, and they're just driving margins down, which make it sort of uncompetitive for anyone else to compete. Do you think that's an issue?
There is no doubt that the Chinese government has an overt commercial policy. I would point out, and by the way, I'm a veteran banker starting another bank, that the United States has something called federal deposit insurance, which means when you deposit money with a U.S. bank, you aren't paying as much attention to the bank balance sheet as you ought to. You're paying attention to the Fed's balance sheet, which is to say that the United States is engaged covertly in the same political process of picking winners and losers that the Chinese do. The Chinese are just doing it in a much more overt sense. Let's just say that perhaps the Chinese are more efficient at their favoritism than the U.S.
Okay. Do you think then the US would have to sort of compete on the same level then and favor,
Not at
different
all.
industries? No.
Not at all. What the U.S. has that the Chinese don't have yet is still a deeply entrepreneurial culture. The United States is still a place where 5 or 6 young people can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Facebook. We are still a country where, after 100 years of trying, our individual creativity and tenacity has been able to fund our collective stupidity. The Chinese may get there, but we have a decided cultural advantage, and we have a decided cultural advantage in terms of education and entrepreneurship that might not last, but for the time being, if what we were willing to do is change the focus of our society on wealth creation as opposed to wealth consumption, I think we would become much, much, much more broadly competitive than we are today. It's impossible to overstate the importance of the tax code on investments. Wages rise because output per worker rises. Output per worker rises when education and capital employed for workers increases. Changing the tax code to favor investment over consumption is the single most important thing that we could do in the United States to become, again, more globally competitive.
And why has that shifted over the past, I'm guessing, 50 years?
I think voters would prefer to live rich than to be rich. There is the politics of envy in the United States, which suggests that somebody who invested money and created a product and became a billionaire is somehow an evil human being, as opposed to when you think about how much utility that person created on the way to becoming a billionaire. The politics of envy and the preference for consumption over production, I would suspect, is responsible for most of America's political demise.
Okay. Yeah, no, I guess that's each party have sort of gone into that over the past, however many decades.
Yeah, I'm not myself a Democrat or a Republican. I notice that neither party does a particularly good job of reducing the size of the government, or for that matter, making the nation more free. The two issues which are important to me.
Yeah, definitely. So you see this current trajectory of what Trump, at least for tariffs, is negative, but I guess there's also the side of things where it seems like he wants to use this as a way to raise funds to potentially decrease taxes and do other things.
It is interesting, like other politicians, that he seems to talk out of both sides of his mouth. He talks about making government smaller at the same time that he urges Congress to pass a continuing resolution to increase the debt ceiling and deliver the third or fourth or fifth largest quarterly deficit in history. Those two facts seem to be incongruous together. I guess I'll have to wait. I would recommend to your listeners a wonderful book about this process. The book is called The Triumph of Politics. It was written by David Stockman. David Stockman presided over the Office of Management and Budget in the Reagan years. For those listeners that you have who are old enough to remember the Reagan years, you may remember that Reagan won the election by a landslide, not by the narrow margin that Trump did. And there was a national mandate to reduce the size of government. That mandate was derailed by Congress, both Democrats and Republican, within 6 months of Mr. Reagan's inauguration. So if you're looking at how this administration might reduce debt, deficits, and government spending, it's important to look at what they did in terms of the recent budget and the continuing resolution. And it's also important, I think, to look at the history of the last major effort that we had to reform our government, which was sadly very unsuccessful.
So I imagine you think this one will be unsuccessful as well, this attempt?
There's no certainties in life, but I would suggest that the probabilities go that way. The problems are very large, and I think it's useful for investors, including the investors on this call, to understand some of them. And I'm not talking about the narrative problems. I'm not talking about Republicans' perceptions or Democrats' perceptions. I'm talking about arithmetic. The on-balance sheet liabilities of the federal government, which is to say what we owe each other and other people, the bondholders, exceeds $36 trillion, or $30 trillion net of the Fed's own balance sheet. That's a pretty big problem when you think about that gross government revenues before any expenditures are $5 trillion. But a bigger problem is the off-balance sheet liabilities. The net present value of unfunded government promises, things like Medicare, Medicaid, Social Security, military pensions, federal government pensions, the Environmental Trust Fund, these types of things exceed, according to the Congressional Budget Office, $100 trillion. That's at the federal level, before state, local, corporate, and individual debt. If you add the on-balance sheet liabilities to the off-balance sheet liabilities of the United States government, what you find out is that at the federal level, we're $130 billion in net indebtedness. That, in turn, is problematic when you look at the aggregate net worth of American people. The Internal Revenue Service, who makes it their business to know what you're worth, suggests that the aggregate net worth, private net worth of American citizens is $141 trillion. And of that, $130 trillion is pledged. This is the nature of the problem. This is a real problem. My suspicion, which will tie this back to investments and finance, is that the way that we deal with this program is, yes, we finesse some of the net present value. We raise the entitlement age for Social Security, stuff like that. But that really doesn't matter. My suspicion is that what we do as a society is what we did in the decade of the 1970s. We debase the currency. We reduce the purchasing power of our obligations so that we honor our obligations in a nominal sense, but not in a real sense. The Office of Management and Budget suggests to us that in the decade 1970 to 1971, the purchasing power of the US dollar was reduced by 75%, which means that $1,000 of savings in 1980 bought $250 worth of goods in 1971 prices. It is not coincidental, I think, Anthony, that during a period when the purchasing power of the US dollar declined by 75%, that the gold price increased 30-fold. I'm not suggesting that the gold price will go up 30-fold from here, but I am suggesting that in the next 10 years, the purchasing power of the US dollar in terms of devaluing our debts will go down by 75%. And I suspect that assets that have traditionally done well during periods of time when the purchasing power was under fire will do well. And I suggest that gold is one of those assets.
Do you think it might be different? Because I guess the risk is that there's going to be a lot more retirees than I imagine in the 70s. And so that could be a risk.
Well, it is a risk. It's important to note that we went into the decade of the 70s with on-balance sheet liabilities at about 35% of GDP. We're going into this period with on-balance sheet liabilities at 110 or 120% of GDP, which is to say our debt relative to our gross economic activity is 3 times as big as it was going into that crisis. That's a problem.
Yeah, and which assets? Yeah, so 3 times the debasement.
Yeah, I'm not suggesting, by the way, that your listeners curl up in the corner in fetal position, that things are hopeless. Things aren't hopeless. We'll get through this. We will have a reckoning, a 10-year reckoning or a 15-year reckoning. Those people who make hard choices now and prepare will come through that better than other people. But you do have to act. You have to act on your own behalf. If you are a younger person and you believe that you are entitled to the type of retirement that you have been promised by your government, you need to think again. You need to prepare for your own retirement. You need to begin saving now systematically. You need to live below your means. You have to store some of your savings in investments or in asset classes that traditionally have done well during periods of time when fiat currencies were debased. You have to learn from history, and you have to apply yourself now to protect yourself for this reckoning that I think you need to assume will occur as a consequence of the arithmetic around our debt and deficits. There were two broad asset classes that did well in the decade of the 70s. One was public companies that had dominant enough products or market share that they could raise their prices to keep pace with inflation. It's worthy to note that Warren Buffett, through the decade of the 70s, generated 25% compound annual internal rate of returns, not following fads, but rather owning things like American Express, Coca-Cola, See's Candies, businesses that were fairly mundane, but that had products and services that were valuable enough to consumers that consumers were willing to stomach price increases that were commensurate with the rate of inflation. The other asset class, which works very broadly well in periods of inflation, are natural resources, but particularly precious metals. If you look back at the decade of the 70s, the copper price went from 30 cents a pound to $1.50 a pound. The oil price went from $3 a barrel to $25 a barrel. The price of decontrolled natural gas went from 30 cents a million BTU to $12 or $13 per million BTU. Not coincidentally, the gold price went from $35 to some number like $800 or $850. The broad range of resources did well. What did poorly? Long bonds, something where your yield is frozen, but inflation eats up the net present value of that yield over time. Really murders you. At the beginning of the decade of the 1970s, I think the prime interest rate was like 5.5. At the end of the decade, it was 15.5 or 16. What that means for somebody who owns a 30-year bond is that the purchasing power of their bond coupons is a quarter of what it was at the beginning of the decade. And the principal value of the bond falls substantially as well.
Okay, and then a lot to touch on that. If we look at the first type of assets you're talking about there, the products, the assets, general goods, what impact would tariffs have on that? It seems like maybe they would struggle to then pass on that cost to the average consumer.
Well, certainly the ability that, as an example, an American consumer products company like a Procter & Gamble or a Hershey would have in terms of selling their products overseas, but also in terms of the inputs. This is going to be very challenging. You are going to be less and less able as a company manager to pay attention to the market when you have to pay attention to the government instead. Not just your own government victimizing you, but other governments victimizing you as a consequence of trying to get even for what your government did. It will make life very much more difficult.
Yeah, and it seems like it could lead to a bifurcated world, which then, especially trade, which then could impact commodities as well.
I suspect more than bifurcated. I suspect that you'll have the European community, perhaps, versus the North American community, versus the Asian community, which itself will be fractured, versus emerging and frontier markets. And even within those blocks, those natural blocks, I suspect that you're going to see a lot of stratification. The idea that there won't be non-tariff barriers is an example between various European companies that are part of a tariff and trade union, I think is inevitable and unfortunate.
Okay, so you see, basically all regions pushing back to this protectionism, and I guess with AI as well, that's potentially going to fast track the issues of manufacturing jobs, production, all these other aspects.
And the truth is, we all live in this world. We all need to take advantage of every tool that we possibly can to lower our production costs and to make ourselves more efficient. What this means on an individual worker's basis is that worker is going to have to reinvest in his or her knowledge base. Rather than being put out of business by AI, they're going to have to learn how to employ AI to make themselves more efficient and to increase the output per hour they work. That's where wage increases come from.
Yeah, but I guess that's been the challenge in the US with those places that used to be manufacturing heartlands not being manufacturing heartlands anymore, and that the individuals haven't upskilled. So I guess it is a challenging thing to do.
I think as individuals, we've preferred to believe lies as opposed to prepare ourselves. And I think our government found themselves being easily elected if they continued to lie to us. The reckoning is coming home. From an investment viewpoint, how do we build heavy industry in the United States where we allow capital investments to be amortized over 30 years, and the Swedes and the Russians and the Japanese and the Koreans and the Chinese expense them? Think that through. Think the cost of capital. To the extent that we're going to become competitive, we have to become competitive. You don't become more competitive by making the other people artificially less competitive. That's not the way the world works.
Okay. So you think that has to change for manufacturing in the US to,
And I think
and I guess other aspects as well. Yeah.
I think it will. I think it'll take time. You can't get around arithmetic. If you are going to have manufacturing jobs, you have to have the capital equipment that supports them. And you can't have the capital equipment flowing into the US when that money is treated better elsewhere. It doesn't work that way. Money goes where it's treated best.
Yeah, great point. And you mentioned, precious metals are potentially going to benefit as well, as obviously gold's had a massive run up. Yeah, what do you think is behind that? Is it the uncertainty in the system? And I guess why haven't we seen that in other commodities?
It's just arithmetic. Gold has done well traditionally when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. So again, let's look at the math. Although the government would have you believe that the deterioration of the US dollar is only 2.6% compounded, that's the CPI, or as I like to call it, the CP lie. Common sense says that the deterioration of your dollar is much higher. First of all, the CPI doesn't include tax. And I guess, Anthony, if I didn't have to pay the tax, I wouldn't complain so much about the index. I believe that if your listeners conducted a common sense thought experiment, they could challenge the CPI easily. Put together a basket of goods and services that you used in 2020 and still use today. Your car, gasoline, rent or mortgages, health insurance, health care, groceries. What you will learn by constructing your own basket of goods and services is that the purchasing power of your savings is declining by more like 7.5% or 8% a year than 2.5 or 2.6 a year. Now, let's put that in the context of your savings. The world's premier saving instrument, the one that everyone else is priced against, is the US 10-year Treasury, the world's benchmark Treasury. Using it as a proxy for savings, if somebody buys the US 10-year Treasury today, the US government solemnly swears to pay them, 4.5% or something like that? In a currency where their purchasing power is declining by 7.5% a year, which is to say, if you save money and you loan it to the US government, they will cost you 3% a year compounded for 10 years. In 10 years, they will give you back about 60% of the purchasing power that you gave them now. What could make you more nervous about the maintenance of the purchasing power of your savings than a government guarantee that they were going to cost you 40% of those savings over 10 years? I would suggest that if history is prologue, that the current rate of the deterioration of the purchasing power of the US dollar relative to the yield that is commonly available to savers almost guarantees that the gold price continues to do well. And by the way, Anthony, I think it's important to note that this performance in the gold price, while it's become more noticeable of late, has been going on for a very, very long time. When people in these interviews say to me, or said to me a year ago, Rick, when is the gold price going to finally move? I would say, I think it's going to finally move beginning in the year 2000. In 2000, the gold price was $250 an ounce. Now it's $3,000 an ounce. 25 years, gold is up 8.5% or 9% compounded for 25 years. Gold has been maintaining its purchasing power while the purchasing power of the dollar has been deteriorating, and it's done so for 25 years.
Okay. And do you see exclusively gold as because I guess if you look at silver and then palladium and other metals, platinum, they haven't done as well?
I'm attracted to the whole precious metals suite, but in my experience as a director, as an investor, Anthony, I have noticed that precious metals bull markets are led by gold. They're led by the fear buyer. When the price momentum in gold becomes noticeable to the generalist investor, when the generalist investor comes down into the precious metal space, perhaps because of its lower unit cost, silver begins to outperform gold. We haven't seen that occur yet, and I'm not actually really sure why it happens. I've just noticed that in 3 prior bull markets, it has happened. When the generalist investor becomes attracted to the precious metals narrative as a consequence of the momentum in the gold price, leadership changes to silver, and silver then moves further and faster than gold. I think from the point of view of platinum and palladium, that they are cheap, not merely relative to gold or silver, but relative to a basket of commodities, and in particular relative to the utility that they command as industrial materials. And I think that they will do well over time. But I believe that from an investment perspective, gold right now will maintain its leadership role.
Yeah, and a lot of people have been talking about the fact that it's because the BRICS countries have been buying up gold to diversify away from the dollar. Is that something that you think has essentially been causing this?
I do. I think it's important to note that until very recently, most of the move in the gold price has happened as a consequence of central bank buying. And I think you need to look at the causes of that. The first cause of that would, of course, be the weaponization of the US dollar. The US government, abusing its status as the issuer of the world's reserve currency by, among other things, manipulating the SWIFT banking system, international property, not American property, and also, irrespective of how you feel about Russia's actions in the Ukraine, stealing $300 billion in Russian treasuries. That action caused many countries that would ordinarily keep their savings in US treasuries to consider again if they would earn the ire of the US government. Let's say, as an example, if they were China or Iran or India, whether or not they could afford to keep their savings in a country that would steal their savings. The second thing, of course, is that the math that I described, the yield on US treasuries relative to the decline in the purchasing power of US treasuries, has come to cause those countries to believe that in addition to the fact that US treasuries are a dangerous asset class, they're an unattractive asset class for simply arithmetic purposes. When people asked me last year, I can no longer say this, when people asked me last year why the gold price was going up faster than the gold stocks, I had an easy answer. The gold price was going up because foreign central banks were buying gold, but foreign central banks weren't buying gold stocks. The buyer that was causing the price action was absent from one asset class while they were prevalent in the other. Just recently, the last 12 weeks, you've seen retail inflows into precious metals ETFs, the physical ETFs, which means that the retail buyer, the individual buyer, is coming back into the physical gold market. And that same buyer is buying gold stocks. So now you're seeing a rally in both asset classes, which is very consistent with prior bull markets.
Okay, and you think the bull market could have further to go?
If past is prologue, yes, I do. I don't see any way, Anthony, that our society can deal with $130 trillion in debt when our private net worth is $141 trillion. I think that the only way out is inflating away the net present value of our obligation while politically honoring the nominal value of our obligation. And if the social response to the deterioration of the purchasing power of the US dollar is the same as investor responses has been for a millennium, gold should be a real beneficiary of that trend.
Okay, so yeah, more still to come. Potentially, if we look at, I know we spoke about energy last time we spoke 6 months ago, and it's actually had quite a bit of a drop recently because of the tariffs. There's, I guess, concerns of GDP growth around the world, as well as OPEC plus increasing production. So, what are you currently seeing in, I guess, in oil and gas is a little bit different, but yeah, just oil mainly.
Oil and more recently copper seems to be suggesting to us that investors are afraid of a recession. Certainly oil responds to immediate rather than longer-term economic pessimism. And it could be that on a global basis, we're experiencing an economic slowdown. That's what the oil price would seem to suggest. Looking longer term, the increase in oil production was largely a function of one country, the United States. And my nervousness as a U.S. oil investor, and I am a U.S. oil investor, is that most of the increase in production that we've seen in the United States is a consequence both of a very low cost of capital for American producers, but more importantly, the conjunction of various new exploration and production technologies. That production growth, particularly in the Permian Basin of the United States, would seem to be slowing, which is to say the industry believes that in terms of their grade A undeveloped locations, that they've drilled about 85% of their inventory, so they have 15% less to drill. The attractiveness of those locations left to drill is a function, A, of the technology. So if technology improves, that number could increase, but also the cost of capital, and interest rates are rising, and the price of oil, and the price of oil is falling. One could expect, with the diminished number of grade A locations and the increasing cost of capital and the decreasing oil price, that the ability of the United States to continue to supply the oil and gas that the world needs in transition is declining. And the consequence of that is that I think you see oil prices in 2 or 3 years, not merely higher, but probably substantially higher than they are today.
Yeah, that's a good point, and I guess it's a sort of cycle where they'll come back online, the shale, once it's once the price is higher, and then
Sure.
overproduction, and yeah, this constant cycle.
That's a function of interest rates, by the way. You can look at the variables in isolation if the interest rates don't rise. If the interest rates rise substantially and the cost of capital goes up, that cost of capital can eat a lot of the benefit of increasing oil price too.
Yeah, that's a great point. And then you mentioned copper there. So I know traditionally it's been linked to the Chinese economy, but now it seems to be, as you said, the global potential for slowdown.
And Anthony, understand we're pretty interdependent. The Chinese have been able to finance their growth by selling us stuff. And to the extent that it becomes less attractive for us to buy their stuff, or to the extent that we become gradually poorer and can't afford to pay, the Chinese will feel that irrespective of tariffs.
Yeah, sure. So do you think do you see copper sort of maybe further going down, or you think this is just a short term?
I think in the near term, copper could go down a little more because I'm not an economist, but I noticed that it's been a very long time since we had a proper recession, an economic slowdown. Looking longer term, and by longer term, I mean 5 to 7 years, I think it's important to look on the bright side because I think the side is mostly bright. There are 8 billion people on Earth, and we've done a wonderful job over the last 40 years of increasing the material living standards of the poorest of the poor in the world. But there's still a job to do. There's 1 billion people left on Earth with no access to primary electricity. My suspicion is over the next 20 years, they get it. That means that demand for power, first of all, is going to go up. And it means that demand for the stuff to get the power from where it's produced to where it's consumed, mostly copper, also goes up. So I think the ascent of humankind will be an important component of the increase in copper demand. Meanwhile, for 30 years, we have underinvested in copper supply, in exploration, in development, in construction, in production, in sustaining capital investments. These two lines, reduced supply as a consequence of constrained investment and increasing demand, will, I think, over 5 years and 6 years and 7 years and 10 years, do a job on the copper price. The other thing that will do a job on the copper price is mere inflation, which is to say, the real price of copper might not rise an awful lot, but the nominal price of copper, expressed in US dollars or euros or renminbi or British pounds, could go up substantially. And inflation does a different thing. It raises the capital cost to put new capacity in production, which is to say, if we were to go build a big porphyry mine today for $10 billion, 10 years from now, putting that same mine into production might cost $40 billion, which means that the existing production is that much more valuable because you have already amortized the expense of putting it in production. So inflation aids at the very least the nominal as opposed to the real price performance of natural resources.
Okay, yeah, that makes sense. And as you're saying, there's need to be a lot more demands. Are you worried about recycling, or you think that's not going to be able to cover the new demands?
We're going to need it.
Yeah.
You know, we're going to need it. I hope that the mechanisms for restoring scrap become more broad based. Make no mistake, we have invested insufficiently in a whole range of material resources to sustain the growth in the material well-being of humankind for the balance of my life. And I'd like my life not to change that much. It's been pretty good so far. So far from fearing recycling, I'm holding out a lot of hope for it.
Yep, great. So, Rick, thanks so much for your time today. Really appreciate it. My last question is, what is one message you want people to take away from our conversation?
Well, I'll make people an offer, actually, to the extent that my case for natural resources and precious metals is compelling. We can personalize it. We can personalize it two ways. The first is you can go to my website, ruleinvestmentmedia.com. There, list your natural resource stocks, and for no cost or obligation, I will personally rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might have value. Secondly, the very best work I do is in my investment conferences. I've been doing them for 30 years, and I have one coming up. The Rule Symposium, July 7 through 11 in Boca Raton, Florida. You can attend live, which I would prefer, or in the comfort and convenience of your own home via live stream. Last year, attendees came from 33 countries via live stream. However you intend to attend, live or live stream, you have a full money-back guarantee from me, which is to say, if you don't believe for any reason that I haven't delivered the value that you have paid for, I will cheerfully refund your tuition. No other investment conference on the planet makes that guarantee. We can do that because our product is so good. For 30 years, we've had to refund less than 0.1% of the tuition that we charged. Once again, the Rule Natural Resource Investment Symposium, 2025, Boca Raton, 7 through 11. By the way, attending either live or live stream, you'll have a year's access to the complete recordings of the conference, and you'll need it because we're going to give you 50 hours of valuable, in-depth content, more than you can absorb during the 4 days of the conference.
Yeah, great. That's a great message. We'll put in the description below. But yeah, Rick, thanks so much for your time today. I really appreciate it.
Thanks for the opportunity.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.